flattish as was expected. Now, Venugopal Garre is joining us. He's Managing Director at Bernstein, and he's with us now from Singapore. Venu, great to have you with us here. Thank you very much for your time. You've been sort of meeting with chief investment officers across some of the largest Indian mutual funds extensively. So many meetings. I just want to kind of start by asking you, what are the key takeaways? What stood out for you from a sort of India investment landscape perspective from here out?
Thanks, Prashant, and thanks for having me on the show. Yeah, so I of late have been meeting quite a few of the CIOs across the world, including in India, and I would probably say that I was a bit surprised because I was expecting a sort of a bearish sort of a sentiment, on the ground, especially given what was happening in the global economy. And this was a time about a few weeks back when we had actually seen a round two of concerns emerging globally. And apart from that, domestically as well, as the situation where macro has been slowing down and there were certain areas of concerns emerging, what I sort of observed is that there was very clearly an underlying bullishness that was sort of there in my conversation that I could hear from them. And I guess the broader thinking from a top-down point of view that I could gather is the fact that there is broadly a consensus emerging that perhaps we are more close to the bottom in terms of GDP growth rates. So maybe we don't really see any incremental GDP dent from here. So that is one major aspect. And the second thing, I guess, is also the fact that we've seen a time value correction in the markets for almost 18 months. It's been moving sideways. So to that extent, with earnings not really seeing any major cuts, we've actually seen some valuation correction as well, which was also cited as one factor, important factor. And third thing, I guess, is I saw that there was this perspective that flows from a domestic point of view perhaps will still be sticky for a while, despite interest rates moving up, which was, again, perhaps is sort of a unique takeaway. So which is the broader thinking from a top-down point of view. I just want to quickly highlight the sector views that emerged, because it sort of diverges from this top-down underlying bullish view. Because I think most of them were negative on IT services still. They were negative on consumption overall. There was positive on financial, but still very skeptical. And the big positive areas that I felt, underlying was autos, industrials, where there was positivity, but these are very small sectors. Now, if three of the largest sectors, either you are not positive or a bit skeptical, then I think the top-down view doesn't really marry the bottom-up view. So what primarily means to me that there is still this potential for, a relatively lower return environment, which is still emerging from there. And I guess it is more a question of a 3-year view or a 2-year view rather than the next 6-month view in terms of how most of the top CIOs are looking at things.
So, Venugopal, just to summarize what you've said so far, are you trying to say that if we are close to the bottom in terms of GDP growth, there has been a time correction now for 18 months and perhaps pricing in a lot of the bad news, do you think the worst for the Indian equity markets is over? And are we staring at some sort of, bottom formation and then perhaps a leg of an up move in the second half of 2023? Is that a fair way to look at it?
Sorry, that's a fair way to look at it. That's basically what my original thinking was, that second half of the year, I should start to look at things positively, the Indian market. That was my original view as well, which was the outlook view. But my thinking was primarily that, you have to see a convergence of a lot of things apart from GDP. See, GDP at 4.4 can't go to 3, right? So we are very clearly going to move sideways in GDP from here, maybe not much of a correction. But then the global economy, we need to really see where things head. Because I guess directionally, we're still not sure of where interest rates peak. We're not still sure of, the direction in terms of what kind of a recession we're going to see. In my perspective, simply around there is that there could be a protracted downturn globally. So what it means is that when we talk about a recovery in the second half of the year, the slope of the recovery is still a question that I have in my mind. At this juncture, I'm thinking of probably a positive view if index falls below 16,000, for example, in the second half of the year. But then the point is start to buy. But then how much returns can you make? Are you going to make 25% returns from there? I don't think I'm in that camp. I'm basically still talking about positive returns in second half. So that's the way I would probably construct it given the uncertain environment that we are still in.
Hi, Mr. Garre. Good morning. we ask a lot of guests out here about how things are different currently from 2008. And you have written a nice detailed note that things today are very, very different from the global financial crisis. That's heartening from my perspective, at least. Give us a few details and why you believe this time it's very different.
Yeah, Nigel, so basically the world is worrying about GFC, right? And the point is that on the top of it, you'll basically see a lot of similarities. And given that people tend to be, looking at similarities and, sort of think that the same outcomes would emerge, unfortunately, my viewpoint is very different from what I've actually seen being written globally. Now, my thinking simply is that, look, the differences are very, very clear and stark. At this juncture, I don't see it as a consumer problem. And when I'm talking about it, I'm probably talking about US, for example. It's not a consumer problem. That was basically a consumer problem at that point of time, especially around, mis-selling of loans, even the credit quality or scores at which loans were being given were very, very different. So you primarily saw a situation when interest rates, increased. There was a pretty large problem with MBS at that point of time. But at this juncture, you see primarily a situation where it's an interest rate-led impact on investment books of banks. Now, that backstop can be supported through liquidity, which is what Fed is doing. So this is not a permanent damage to the quality of the assets. It's basically a temporary damage, right? So that liquidity can manage. The second thing is what I see is policymakers this time globally. You've seen that not just in US, but also in Europe recently with what happened to CS. The reality is they're acting really fast, even before problems emerge. So as to ensure there is no systemic risk that can ripple down, the overall financial ecosystem in the world. The third most interesting thing is the fact that global cycles haven't converged right now. 2003 to 5, 2003 to 8 was a global synchronous upturn. So there was sort of excess froth everywhere. But you look at the current situation, end of the day, 3 of the largest economies of the top 5, China has not really seen much growth in the last 12 to 18 months. So they're in a very different cycle at this point of time. India, I would still call it early cycle in the sense that our economy basically is still higher than what we were in 2019, but not like majorly higher. So we're still early cycle, even though we're weaker at this juncture. So what it means is that, even globally, there are some countries which might still hold good. They won't really fall too much in terms of economic growth. Well, you might see some moderation in US. So it's a balance at this juncture. So this is a top-down view. There are a lot of other details that I mentioned in the note, but my perspective is that don't expect shocks, which is systemic shocks. There are checks and balances which will ensure that will not happen, which primarily brings down the view that the interest rate trajectory to bring down inflation as an effort will continue, but then which means that you're not going to see immediate recoveries as well. Probably it's a 2-3 year pain that we'll have to go through, volatility, some recovery months, some weak months. That's the way it's going to be.
Venu, you also had another interesting report on China plus one. Now, local manufacturing, there's always a fair degree of hope. Sometimes it gets into the exuberant zone, and sometimes it the ebb and flow is there. But on the ground, I think you've looked at where are global companies shifting capacities, and does India figure prominently there? So just your takeaways and your findings.
Yeah, so you're right. Everyone is positive right now on India manufacturing story. But I think there's always a question of what is the magnitude of being, how much should be positive? Is it positive for 1 or 2 small mid caps, or is it positive for the economy today or 10 years later? So what we tried doing here is we tried putting numbers to this. There are about 135 global brands, as I call it, which have taken about 200 decisions in terms of manufacturing shifts over the last 5 years. Now, what we observed is, and in fact, we've done a similar exercise about 3 years back. At one of time, there were 75 companies with 100 decisions. Now, this 135 is cumulative. So the interesting thing is that at that point of time, primarily India was one of the beneficiaries with 10% allocation of those 100 decisions going towards India. Overall capex of those 75 decisions was about 30 billion. So India was getting probably less than $3 billion in terms of even capex investments around those manufacturing decisions. But in the last 3 years, what we have seen is incrementally out of these 135 sort of companies, almost 14% allocations have happened towards India. But remember that while it's incrementally positive that we are seeing more decisions being taken towards India, but the reality is that there are several countries which are actually benefiting meaningfully. Vietnam is a classic example with more than 30% allocation still. And more importantly, we are seeing that a lot of these countries are seeing decisions which are not just assembly, but, in terms of components in other areas. So I would probably summarize by saying that, it's like if I were to just summarize, I'll probably say that, look, we're clearly an incremental beneficiary, but not the only beneficiary. It will probably take 10 years for us to see it starting to impact the economy.
Okay, all right. Well, Venugopal, we leave it at that. Good that, I mean, we started the day on a positive note with you telling us that perhaps the worst of the fall is behind us, and you're expecting the base case is that the market should pick up in the second half of the year. Hopefully that plays out. We're close to the bottom, at least in terms of GDP growth for the country. So that's good. Thanks a lot for joining in, and hope your day goes well. Well, that's the word coming in on the market.